Welcome back to the HFR podcast. Today we continue with part 2 of my discussion with Dr. Zoe Liu of the Council of Foreign Relations to discuss China's sovereign wealth fund and its goals for growth and sustainability. Check out our YouTube playlist for part 1 of the discussion, where we cover China's digital economy and its policy position on cryptocurrency. I'm fascinated by your research and by your personal journey. Is it easy to access the things you're able to write about? What is your research process like?
Thank you very much, Anika, for raising this question and from one macroeconomist to a fellow. I feel like I really appreciate this point that you raised. For me, I feel like doing research, broadly speaking, there are just way too many different signals and sometimes conflicting signals, especially when we try to work on things related to the Chinese economy. So what I do is, yes, I take as a given that like any government data can be misleading if you only reliant on those, but the trend matters the most, right? So I try to triangulate by combining different sources. And more importantly, I value every opportunity, especially in the context of doing China research. I value every opportunity to visit China, talk with Chinese entrepreneurs, Chinese scholars, and the Chinese policy people. So from that perspective, I try to piece together, different sentiment, try to sort of get the feeling or try to put the feeling on numbers, if that makes sense.
Absolutely. That's wonderful. And it raises another very quick question in my mind, which is, I've seen some of your congressional testimony, and I know that some of the work that you do and the research you provide has strategic importance to the U.S. Do you find on your visits to China that people are aware of that? And are they happy to talk to you?
I have certainly received emails asking me, are you being too critical of China because you pointed out that there are some strategic weaknesses in the economy? And some people even ask me, do you plan to never go back to China? So I treat these kind of questions with skepticism, in the sense that, yes, I understand, in the media in particular, there are so-called exit bans and all that. But then, my experience is that as long as individuals, as scholars, we are doing honest research and we let data tell the story rather than trying to start with a particular ideology, as long as the research is not driven by a particular kind of ideology, then I think it is fine. And in fact, through my interaction with Chinese scholars and Chinese policymakers, especially those really good economists and technocrats, when you pointed out that, there are problems in your thinking, it's in private setting, of course, they are actually very receptive. They would perhaps for people in higher positions, very rarely their underlings would challenge them. But for some outsider like me, they are not my bosses. In my context, we work in intellectual environment. It is okay. It's our nature to question and to try to question not just the assumptions, but also try to figure out what is missing.
I want to switch gears just a little bit to talking about the sovereign wealth fund of the Chinese government. And I have to say, big plug for your book, because it is fascinating. And so I would like for you to talk about how you see the Chinese government tackling the maturation of the Chinese economy with regard to its sovereign wealth fund activities. So how is the CIC being used to tackle structural change in the economy? And furthermore, is the CIC going to be under any pressure given the reorganization of trade and capital flows, foreign exchange reserves, given the U.S. administration's newer policies this year?
Yeah, thank you, Annika, for mentioning my book, Sovereign Funds. That book is half of my doctorate dissertation, and I did try to understand how China, being the world's largest commodity importer across many spectrums, tend to have some of the world's largest sovereign funds when people tend to think sovereign funds are sort of almost exclusive privilege of commodity exporting countries like UAE, Qatar, Kuwait, or Norway, and Saudi Arabia. And the reason I mentioned half of that is because I compared China versus Japan, because the puzzle would be Japan is the world number 2 largest foreign exchange reserve holder, but Japan specifically rejected, Ministry of Finance in Japan specifically rejected the idea of using foreign exchange reserves to establish Japanese sovereign wealth fund. So the book is the China part. And you're absolutely right. There is CIC, and there is also a series of SAFE or state administration of foreign exchange affiliated investment companies. And in the context of addressing the challenge of economic slowdown, I'd say Chinese sovereign funds have a big role to play. And I'll start with the first one, which is a lot of people ascribe China's current economic slowdown to a large portion to the property sector slowdown. And the bubble seems to be on the verge of being burst. And now if you look at the recent numbers shows that even property prices, even in first and second tier cities, has been deteriorating. The idea that the government tries to stabilize the housing market, trying to stabilize the prices, hasn't been making much significant progress. And because of housing sector slowdown, people are concerned that Chinese banks, because of their exposure to the bad property developers, as exemplified by Evergrande, people are concerned about banking sector is going to implode as a moment of even China's Lehman moment. So from the get-go, I think this property sector is unlikely to trigger a banking crisis in China. And this is not China's Lehman moment, specifically because China knows the government understand how to address banking crisis, and they have had very successful experience addressing even bigger banking crisis, specifically by using Chinese foreign exchange reserves back in the early 2000s. And this is also the very first time when the Chinese government used the foreign exchange reserve to address the immense crisis. So from that, like the specific example, and I explained in detail in my book, is how the government created a central Huijin using foreign exchange reserves to solve China's looming banking crisis because of the non-performing loans. And as a result, the recapitalization was so successful that when you think about ICBC, Bank of China, China Construction, Communication Banks, these are now among the world's largest banks. So from that perspective, this is why I say the Chinese central Huijin today is going forward will play an even more important role in stabilizing Chinese domestic financial system. And it knows how to do it. And related to this, I'd say another example would be China's equity market. Every now and then you hear people talk about, China is going to establish equity market or security stabilization fund. You hear this during COVID. You also heard this last year or in the beginning of this year in the context of looming escalation of trade tensions. But then again, this is not the first time that the government used the so-called national team to stabilize Chinese stock market. Some prominent example would be domestic-oriented affiliation of SAFE. Starting from 2015, they have been investing in China's equity market. Now you ask about the CIC and to what extent CIC is facing pressure. I mean, Anika, you're absolutely right. CIC is facing pressure, and this is not the first time CIC is facing pressure either. I'd say ever since the escalation of U.S.-China trade tension, and especially in the context of the first Trump administration after 2018, the U.S. government strengthened export control as well as investment screening. That really hurted CIC's direct investment arm because, if it's Chinese money, it's going to be under a lot of investment screening by CFIUS. As a result, the lack of deal making, rising national security concerns associated with China and Chinese money literally lead to basically the money cannot be invested. So as a result, CIC's direct investment arm, CIC Capital, had to be shut down. So that's sort of like organizational challenge as a result of tightening U.S. investment screening. But I just say not all is lost in the sense that, CIC over the years has been optimizing its approach and since 2016, CIC has been actively seeking partnership with local influential partner by setting up joint ventures or joint investment funds. CIC has set up investment fund even with Russia and with several European countries, and of course, CIC set up joint investment fund with Goldman Sachs in the context of the United States. So hope is that they can continue allow CIC to invest in foreign countries despite rising geopolitical tension. And the argument is that if CIC provided money and the investment is managed by this joint venture, and this joint venture is registered, say, in Bermuda or registered, say, in the US, then this is from a regulatory perspective. A US registered company is not going to be subject to CFIUS because it's a US entity, right? So I think CIC has been trying to navigate through the changing landscape. But then, given that the Chinese government has been trying to, earlier this year, there has been discussions or reports talking about how Chinese government wants institutional investors in China to reduce their exposure overseas and instead focus on investing in China, focusing on boosting China's indigenous innovation and achieve technological self-sufficiency. I'd say we are likely going to see broader pullback of institutional investors from China's global portfolio. They would still invest their return earning, of course, but additional investment in overseas, especially mega infrastructure project, probably is unlikely. Instead, they would focus more on supply chain financing and invest in sectors that the Chinese government consider as strategic. And they are also going to be more cautious with regard to how global exposure might become liabilities, especially in the context of sanctions.
So the way that China's many initiatives like the Silk Road across the different continents, it's FDI or it's indirect investment, that it may partner, as you were just mentioning in the US context, it may partner with local companies, local corporations in order to make those investments. Is there some thinking of allowing that to happen in the Chinese context?
Right. So I think the core issue you are raising is about additional financial liberalization, right? And I think China certainly remains very cautious about financial liberalization. Part of the reason is because they don't want to remove capital controls. Part of the reason is because they are fear of the mounting pressure of capital leaving China rather than staying inside of China, right? The idea that through financial repression and the interest rate, deposit rate is being kept low and limited other investment opportunities. Chinese people's money has been very hard to move overseas, and their return inside of China is limited. Now, when Chinese officials talks about attracting FDI, they have always been very, very open to attract foreign direct investment, especially in sectors that the Chinese government wants to grow. So like a prominent example would be Tesla. Many people would argue that Tesla would not have become Tesla if the Shanghai government did not roll out the red carpet and basically built the factory for Elon Musk, for the Gigafactory and all that. So the idea is that they do want foreign direct investment, and especially in sectors that the government consider as strategic, as important, as a sector that through foreign investment, they want to get not just the money, but also the technology. Sometimes, U.S. politicians tend to call China sort of have this forced technology transfer or IP theft. There is an element. I understand why people would call it that way, but then on the other hand, if you talk with American CEOs, many of them they would say they know the deal that they are getting themselves into. And if you talk with the Germans, leading German companies, auto sector, or the SAP, they in tech, in software, they remain invested and they expand investment in China, not because they are concerned about IP theft, but because the market is so competitive because of, industrial policies, it produced extremely competitive domestic environment. So if you can survive in China, the idea is you can survive anywhere. So I guess long story short, this is to say the Chinese government welcome foreign direct investment, especially in prioritized sectors. That being said, now because of export controls, and now China since 2020 has also strengthened its own export control regime. And there are also Chinese tech companies, because they've learned the lesson of being subject to US technology export controls. And they are also concerned about taking foreign money. As a result of taking foreign money, they would no longer be able to take government support. So you end up having tech companies reevaluate their funding sources. And if they can get money from state-owned enterprises, if they can get subsidies from government, either central government or local government. And as a condition of some of these financial support through the central government or through the Chinese military, they might not want to take foreign money, especially knowing that a rising US geopolitical tension might, at a certain point, force foreign investors to pull back money. Like when US when Congress summon American financial leaders and ask them, hey, if there is a Taiwan contingency, would you pull off your money away from China? Hearings like this do not boost confidence among Chinese startup or Chinese engineers to receive American investment.
Well said. So let me ask you, how is China approaching the energy transition, especially given its digital economy and its lead in AI, both of which are energy intensive and they have exponential growth paths?
Right. The bottom line here is that China, unlike the Trump administration, China takes climate change and combating climate change and sustainable development very seriously. You see this in President Xi Jinping's speech. You see this in the so-called Green BRI and so on. And at the industry level or manufacturing level, China already dominates a lot of this clean energy sector. Like over 80% of global solar and an immense amount of battery technology and all that. That being said, you are absolutely right. China simultaneously is also to lead the race in AI. Yes, this is energy intensive, but I think China views the relationship between AI's immense demand for energy versus the supply of energy as inconclusive at this stage. And they are very much optimistic that by optimization of AI models, by the application of AI through the entire industrial ecosystem, not just one particular product, but it's through the use of AI throughout the entire ecosystem, there will be tremendous amount of efficiency gain and waste reduction. So by doing that, in the long run, the hope is that the AI revolution would benefit China and not just industrial efficiency gain, but also reduce energy cost and reduce energy waste, especially in certain cases like long distance ultra voltage electricity transmission, and by the application of smart monitoring and using AI through the entire power system nationwide. And of course, the development of clean energy and renewable in particular in China, there is a strategic element there as well. And it fits into China's campaign for self-reliance. They don't like the reason why they put a lot of this bet into renewable or clean energy. Yes, there is climate concern. China's heavy pollutant, like the China's lung cancer rate, is top of the world. So they wanted to combat that. But then there is also the concern about energy security, because China import about 70% of its hydrocarbons consumed domestically. And China doesn't dominate its global sea lanes. And there are a lot of strategic choke points that the Chinese Navy has no control over. So they would want, if China can, or different localities, different companies, or even household can produce their own electricity and shift the surplus into other parts, supply the industrial development, I think for China, they view that as part of this self-reliance or self-sufficiency strategy. So it's more than just climate.
So I don't know if you recently saw the reports of how AI adoption within the United States has been slower than we would have anticipated. And companies are struggling to find proper applications and usage of AI. They may even have developed an AI agent within the company, but then they find that its take up is not really contributing much. How far along by comparison are Chinese corporations in the use and application and creative outlets for AI? Do you have a sense of that?
I haven't visited all Chinese companies, but through the tech company and manufacturing companies that I've visited and the people that I talked to, at least folks are very enthusiastic. Every single one of them that I've met, they don't talk with me. These are the 5 reasons why we should be cautious about AI's negative consequences. They don't really talk too much about AI ethics or safety. Instead, they just move forward with it. They are very enthusiastic about different application scenarios. This is why, AI models are being used in battery safety tests and things like that. And there are also consumer application scenario because, like Chinese system is already very digitized. So in a way, as when we think about a platform economy and a so-called influencer economy, China is certainly more advanced than the United States. And when we think about the industrial system, China certainly has a more complete supply chain and manufacturing system than the United States. So from that perspective, I'd say yes, at this stage, AI application is in China is more advanced. And by the way, I forgot to mention that the Chinese government also put out strategic, like 10 or 15 strategic AI application scenarios, which include port management, property development or housing, healthcare, pharmaceutical, and consumer tourism and things like that. So you have government identify AI application scenarios. Of course, this is part of the industrial policy system. Folks are going to develop the application scenarios at firm level, at even local government level, right? But that said, I do have to say that I think the report either through MIT's report is not the only one, but there are several MIT and the economist report is several talking about AI adoption rate is so slow. I don't quite understand why we are jumping to that conclusion. It's so early. On the one hand, we're talking about, this is the early stage of AI revolution, and we don't even know how AI agent is going to develop going forward. And then on the other hand, we're also complaining that firms are not developing or accepting them fast enough. I'd say we are probably being too harsh on American companies. And I do think that the biggest innovation or the biggest innovation how AI can bring is in 2 areas. Yes, there we talked about a consumer, but then on the other hand, the cases for firm application is just tremendous. And we haven't paid enough attention to how AI changed how accountants and the lawyers and the tax payment system, how tax are being filed. And for that matter, reading books, efficiency gains. And then, of course, people talk about the hype of AI be used in drug development. But then again, it used to take decades for people to identify another antibiotic. But because of the use of AI and the new synthetic materials, I'd say we are being too harsh on American companies. It's too early to say.
Well, that is fabulous. Zoe, I cannot thank you enough for taking the time. Thank you so much.
And thank you for inviting me. I enjoyed our conversation. Thank you.